This is every day. This isn't the morning. The garage is where I can hide.
Okay, hey Marnie.
Yes, ma'am.
I clicked on the revised packet and the DDA packet came up.
That's over here.
Yeah, I noticed that too.
I was very confused for a second.
I'm very confused on how that might have happened because I took the link straight from the. Never mind.
Should I just go to Granicus or are you going to send another one?
What's that?
Should I just go to Granicus or are you going to send another link?
I don't know where to find it.
It's on the council meeting page. Hold on just a sec.
Thank you.
Joe, are you both today, man?
A little chilly.
My tulips are pissed off.
Yeah. Look forward to actually spring happening. It's 70 out. This office isn't bad out here.
I bet.
Can work, say hi to the neighbors.
You know what?
Building-
Go shut this door. I don't think you need to see my toilet.
Okay, I just resent the link from the city website for this meeting, so you should have it.
Okay, yep, that's it. Thanks, Marnie.
Sure.
Clearly, we all reviewed the agenda yesterday.
Yeah. All right, I'm gonna go ahead and start the recording here.
Okay, we all ready to go?
We are ready to go.
Okay. Then we'll begin the joint pension board meeting for the employee system and the police and fire system, City of Ferndale, Wednesday, May 13, 2020. Madam Clerk, roll call, please.
Okay, trustees Gacho,
Here.
Kiana,
Here.
Need,
Here.
TJ,
Here.
and Polika.
Here.
Carol Lachlan.
Here, thank you. Good morning. All right, do we need to go over the procedure for this electronic meeting?
I can go over it quickly if you'd like. There is a feature in Zoom that allows the public to raise their hand if they have a question. So if someone, at this point, all we have is the board and our consultants and staff. But if someone were to show up during the meeting and use the raise their hand feature, I'll just interject and let you know that there's someone who in the public who has a question and would like to speak.
All right, thank you. I guess since I'm relatively new at this, I guess we'll just take it slow and try not to talk over each other, which we usually don't have a problem with anyhow. So for the second item will be the portfolio reports presented by ANCO. Brian, it's all yours.
So one, I'll steal Tom's thunder since he's usually one that mentions this, but for those of you that are doing this via a PC, if you have yourself on mute, if you press the space bar, you temporarily take yourself off mute. So if you want to make a comment and you're on mute, hold down the space bar, talk, release the space bar, you automatically go back on mute. We found that has worked really well. I'll tell you, so far this morning, we haven't experienced the feedback that we've experienced on every other call when people are dialing in from their computer, from their phone, and from their kid's iPad just to make sure that they were fully connected with everything. Am I able to screen share?
Yes.
Okay.
You know what?
Then what I'll do.
Make sure that you can hear.
It says it. Yeah. It says it's permissible. So I'll start on the police and fire side, and I'm going to jump from this presentation to the supplemental just because there's a couple market-related slides that we found beneficial within the within that supplemental deck, just kind of giving a little bit of a long-term perspective. But I'll jump right in, looking at page 3 of the Police and Fire PDF. It says page 1 in the bottom left-hand corner, but it's the overall market commentary. As we look back at what went on in the first quarter of 2020, there was really no place to hide. Outside of cash, high-quality fixed income, and real estate, if you had any risk in your portfolio, whether it was equity market risk or risk from a fixed income standpoint, you were in double-digit decline. The S&P for the quarter was down 19.6%. Most of that came in March when we were down a little over 12%. Mid-cap stocks down 27. Small-cap stocks for the quarter down over 30. International stocks down about 23, almost 24%. From a fixed income standpoint, we saw high-quality U.S. fixed income in positive territory. You see the aggregate bond index up 3.15. But as I mentioned before, any risk. So even if you were in investment-grade bonds, if they were corporate investment-grade bonds, they were in negative territory, down 3.6 for the quarter, and actually down 7% for the month. And if you were in high-yield bonds, the hardest hit part of the portfolio from a fixed income standpoint was the Loomis High Yield Bond Fund. But high-yield bonds for the quarter were down 12.6, almost 12.7%. So you saw a tremendous amount of flight to quality, and any risk, any thought that, frankly, any risk in the portfolio was penalized. From a sector standpoint, even though the S&P was down 19.6%, there was almost a 40% difference in returns between sectors within the S&P 500. So hardest hit was energy, down 50% for the quarter. I don't think that comes as a big surprise for any of us that have had to buy gas in the last 8 to 9 weeks. I was pretty excited to get with Kroger Fuel Points to get it for 45 cents a gallon, and then I realized that I'm probably not going to use this gas tank for the foreseeable future. But energy-related stocks down 50%, and that's no surprise when you see that oil went from just shy of $60 a barrel at the start of the year to 20 and change at the end of the quarter. And obviously, I don't know if anybody's seen some of the news related, but we actually saw oil, at least on a May futures contract, down negative $30 to negative $40 a barrel at one point here in the last couple of weeks. So energy, hardest hit, financials as well, as rates have dropped pretty significantly. But things like information technology and healthcare, not a big surprise, given those seems to be the two biggest areas of consumption as of late, both out of necessity, I think. Tech stocks down just shy of 12%, and healthcare down a little over 12.5%. So those sectors have held in versus others, but really no place to hide from a capital market standpoint. Now, I will give you a little glimmer of hope. Year to date through the end of March, down 19.6. If we take that through today, that number is less than 10%. So we've recovered a little over half the loss we've experienced. If you look from a peak to trough back to peak, the numbers are a little different, but when you take it from January 1 through last night's close, we're down less than 10% on a year-to-date basis. So we have seen a pretty nice recovery here in the month of April, but obviously not enough to bring us back to above the high water mark. So let's dive in from a portfolio standpoint, what works, what didn't. So I am on page 7 of the PDF. It's page 5 in the bottom left-hand corner if you're looking at a printed copy. For the quarter, TNF was down 14.8%. Lagged the policy index that was down 14%. In the last year, down 7.5%. Again, lagging the policy index that was down 6.3%. What helped and what hurt? From a domestic equity standpoint, everything here is going to be right in line because we're passive across the board. S&P, as we've mentioned, down 19.6% for the quarter. S&P low vol, because it has a little bit more exposure to real estate and utilities, held up, but it was still down 19%. Slight outperformance versus the S&P 500, but nowhere near the degree of outperformance you've seen, in downturns of the past. Small cap stocks, as we mentioned, down 28% for the quarter. From an international equity standpoint, it's a mix here of active management with that Bontable fund. Bontable is going to be a little bit more growth oriented, so a little bit more technology, a little bit more healthcare exposure, less exposure to financials, so they fared a little better, down 18.8. just about 4.5% ahead of their benchmark. That was down 23. Vanguard Developed Markets Index Fund, obviously right in line, down 24%. No surprises there. Where we did see underperformance was really on the fixed income side. This didn't come as a surprise. The Loomis high quality portfolio was in positive territory, so they were the single best performer on an absolute basis, just in terms of driving a positive return. But they did underperform their benchmark. So you see up 1.7 versus benchmark up 2.4. Still did pretty well versus peers. In a market like this, right, the hallmark of Loomis is the amount of time and effort and resources they put into individual company research on individual bonds. So they have always been and will always be overweight corporate bonds. So they believe, based on their fundamental research, that they can identify, if I'm going to buy this company's bond, I'm going to get repaid in 3 years, 5 years, and 7 years. So as we mentioned early on, looking at things from a market commentary standpoint, if you had any exposure other than treasuries and agencies, you underperformed for the quarter. So that overweight to corporate bonds, even though they're investment grade, and underweight to treasuries caused their underperformance for the quarter. Longer term results continue to be very, very strong, both versus benchmark and peers. So there's no concern for us here. It's always disappointing to see that little bit of underperformance, but we know exactly why it happened. And candidly, every bit of that has been recovered here in April and May as we've seen markets rally back and risk be rewarded. The disappointment, though, was the Loomis High Income Fund. So this is a high yield portfolio, so below investment grade, obviously going to be down near what, in line with equity markets. But Loomis was down 18.3 for the quarter versus their benchmark that was down 12.7. That number, being 6% behind the benchmark for the quarter, is obviously going to roll in and impact every other time period. We continue to have a great amount of confidence in the team. This is still Dan Fuss and Elaine Stokes, and Matt Egan, really the all-stars of the Loomis fixed income management team. They were a little overweight energy, and if you had any kind of more esoteric bond exposure, things that were a little bit more complex from a structure standpoint, or anything other than, as I've mentioned before, traditional high-quality U.S. fixed income, you underperformed. The one thing that we saw really in the month of March was liquidity in the fixed income markets seized up, similar to what we saw going on in 2008 and 2009. What has given us some solace and some confidence that this is going to continue to improve is, you're talking a couple $1 trillion injection from the Fed. They've stepped into the treasury market, the agency market, the corporate investment grade bond market, the high yield bond market, and have been the provider of liquidity into the system. And that's helped kind of boost prices, and we've seen a pretty meaningful recovery off of the March lows. We have seen downdrafts. We've seen underperformance like this in the past from this team, and pretty consistently a patient investor has been rewarded. The final piece I'll leave you with on this high income fund is, to give you an idea of our continued confidence, is we've been reinvesting back into this. We're not in a position here where we want to increase the exposure because it's at about 10%. But yesterday, for example, I purchased it for 2 other clients, adding to existing exposure. So we're reinvesting where we have capacity back into this fund because of our continued confidence. Final piece from a real estate standpoint, real estate was a positive contributor. We did see a little bit of a lag again out of the UBS Trumbull Property Fund. So they were up basically 0.44% for the quarter versus benchmark that was basically up 1. Longer term results, obviously that 1 year being impacted by the write-downs they had last year in their retail portfolio. They have been, steadily reducing that exposure. Obviously with what's gone on with shelter in place and everything, any kind of transaction activity from a real estate standpoint, other than it seems like some residential housing, has pretty much ground to a halt. There's not a lot of commercial stuff going on. We're finally seeing construction restart, at least here locally. When I was driving around on Monday, I was amazed. We went from having kind of minimal traffic to, I swear, I had to run to Kroger to get groceries on, this is Tuesday morning. There were more contractors on the road, excavators, dump trucks, cement trucks, everything than I had seen in like regular passenger vehicles the day before or the week before. So obviously that underperformance last year is hurting them. You know, they've been a laggard, but I was looking at this last week as we were preparing the report, and then looking at it again last night just in preparation for today. And I would say, well, you know, I look at this and say I'm disappointed in their underperformance over the long run. You know, we've got an almost 13-year history here. You know, our expectation out of core real estate is high single digits. You know, 8 to 9% over the long run. And in the last 10 years, net of fees, UBS has delivered a 9% return. So in terms of long-term expectations, they've been right in line with what we would have expected to get out of core real estate. It's just less leverage and a misstep as of late in their retail portfolio has caused them to lag versus peers. So while we're continuing to look at this in terms of options and whether, you know, we should move on and what we should do here, I do think we should take a step back and recognize that this has been a pretty successful investment over the long run, and it's done exactly what we expected it to do when this was added into the portfolio back in 2007. I'm going to pause here just to see if there's any questions on any of the individual managers or on overall fund performance. All right, I'm going to shift to...
Brian, I do have a question. What are your thoughts on any kind of rebounding going forward? I know it's kind of crystal ball-y right now, but are you thinking 6 months, a year? Is it not going to rebound? Is this going to look like what's kind of your gut on that?
So we've seen, you know, every bit of this. You know, this is going to be a V-shaped recovery. It's going to be a W-shaped recovery. One of the pieces that I read last week, I think it was from Goldman Sachs, was talking about this being an elevator shaft recovery. Because if you think about it, and let me pull up this piece here, you know, to give you some context of what we've experienced. I'm in the supplemental slide piece if anybody's not looking at it on screen. But on page 4 of the supplemental, you know, this plots out the S&P 500 decline we saw in every bear market from 2000 to present. So, you know, the decline we saw in February and March, over the course of 23 trading days, we declined 33.8%. We're now only down 13% from the high. You know, we've had a 31% rally off the bottom, so that now on a year-to-date basis, we're down 8.7%. So you've seen a pretty meaningful recovery off the bottom. But here's where kind of that discussion of, you know, is this an elevator shaft recovery? Because what we experienced this go around, 23 days to decline 34%. In 2008, it took us 251 trading days to get to this point. That's a full year on a calendar basis. In 2000, it took us 264 days. Again, almost a little over a full year of trading to get to the same level. So this decline that we saw, and you think about it, this is really related to, this wasn't, you know, insane valuations in technology stocks and companies being valued, you know, at $5 billion when they've never, you know, they haven't had a penny of earnings. This isn't the 2008 financial crisis where we're over-levered and have a massive amount of debt and just unnecessary leverage of the system. This was, you know, a viral outbreak and a government shutdown of state, local, and federal economies. So we had an elevator shaft down. So the initial discussion is, you know, is this an elevator shaft back up when things start to reopen, people go back to work, people start to spend again? You've seen a little bit of that just because the market's rallied back so much. For us, everything we've read is this all comes back to the science of it, right? Can we get a cure? You know, whether it's, can we get an effective treatment? Can we get a vaccine such that we can return to, you know, some sense of normalcy or, you know, whatever that new normal is? And that, I think, is really what's going to drive things. I think any misstep, any bad news we get from a medical treatment standpoint or vaccine standpoint is going to cause the market to trade back off. But if we have continued success here, we think that things continue. I will tell you, in terms of kind of forward-looking observation, one of the things we've seen is, we work and use JP Morgan for their capital market assumptions. We have since the firm was founded back in 2000, and they traditionally release their forward-looking market returns every November. So in November of 2019, they released their return estimates for 2020 and beyond, and it's a 7 to 10 year return expectation. They just released a new set of updates, and
That's fine.
every
Yeah.
risk category, large cap U.S. stocks, small cap U.S. stocks, emerging markets, real estate, is 1 to 2% higher from a forward-looking return expectation from where it was 4 months ago. And that's based off of this decline we've seen in the markets. But the forward-looking expectation, I will tell you, is better than we've seen in years in terms of, from this point forward, what we expect. So long story short, Cheryl, to your question, we've seen a heck of a rally off the bottom. And I think this holds and will continue to at this level, if not higher, as long as the science side of it continues to make progress. But any bad news we get from a scientific standpoint, I think might cause us to trade back down to, the March 23rd low, if not potentially worse than that.
Thank you very much.
Shift over to employees retirement system.
Are there any questions from anybody on the board about any further questions about the police and fire report? All right, appears not to be.
All right, so let's go to the ERS side. Now remember, ERS is similar from a manager roster standpoint, but we do have a little bit different asset allocation just because of the lower risk profile, lower assumed rate of return. I'll take you right to numbers here. So on the employee side, for the quarter, we were down 12.6. Policy index for the same time period was down 11.4. The reason for that underperformance, obviously the primary is the exposure we had to the Loomis high income fund in the last year. Similar story, down 5.5% versus benchmark down 3.7. Held in pretty well versus peers just because this has a little bit more fixed income, a little less from an international equity standpoint. So obviously when you're talking about negative market returns, that's helped things a little bit. But again, same story for the trailing 1 year. The primary driver of that underperformance is going to be that Loomis high income fund. But our confidence remains and have no recommended changes. So from a manager structure standpoint, we're comfortable. From an asset allocation standpoint, we're comfortable. We do have noted later on the agenda, we do need to raise some cash for both systems. But I will pause and on the retirement system side, or excuse me, on the employees retirement system side, see if there are any questions. Good. Go.
Was someone trying to
Go
say?
in. Do you want me to roll into the supplemental, or do we want to receive and file these first?
Is there a motion to accept the police and fire report?
Motion to accept.
Support.
Roll call. Did you get that, Marnie? We have support too.
Yeah.
Okay.
Okay.
Trustee Gaucho? Mike, Mike Mead?
Yes. Yes.
Trustee Fallica?
Yes.
Trustee Piana?
Yes.
Trustee Pichet?
Yes.
and Chair O'Loughlin.
Yes, thank you.
Would anyone from the employee system like to make a motion to receive and file that report?
I move to receive and file the ERS report as submitted.
Support.
Okay. Trustees Piana,
Yes.
Polika,
Yes.
and Gutcho.
Yes.
Thank you.
All right, the next item is the liquidity funding report for both systems.
So for both systems, we have a recommendation. The funding source is the same. So on the employees retirement system side, we're recommending that we raise $400,000 from the Loomis intermediate portfolio. This would be in two increments, $200,000 increment today and a $200,000 increment in August. And that's projected from a cash flow standpoint to cover us through the November meeting. So it covers the next 6 months of benefit payment needs. Remember, the benefit payment structure on the employees retirement system side is very different than what we have on the police and fire side, just because the system's been closed for so long. We expect benefit payments at this point to decline going into the future, not increase, just because of the way the population is structured. One piece I will note, as we've mentioned, and this is as of Friday, right? Friday. Happy to actually remember what day May 8th was. As we've mentioned, on a quarter-to-date basis, the employee side of things, we've recovered up 6.5% on the quarter-to-date basis, recovered about $1.1 million in market value. So you have seen a pretty nice recovery off of the lows we saw in March. On the police and fire side, we're up about 6.7%, recovered about $2.1 million in market value. And the recommendation here is the same in terms of the source. So we're recommending we raise $600,000 from the Loomis intermediate bond portfolio. Again, drawing from those parts of the portfolio that have held in and have actually generated a positive return through this market decline. We are more cash flow sensitive on the police and fire side. I don't believe there's any retirements planned. So the $600,000 that we need to raise in June, just based on current cash flow estimates. That would cover us through the month of August. So at the August meeting, we'll need to go in and readdress based on market dynamics. Because we need to raise cash on a more regular basis, rather than laying out a plan for the next 6 months or so, I want to readdress here in August just based on what we're seeing to make sure that we're raising cash where we think it's most beneficial.
All right, is there a motion to accept the liquidity plan as submitted? For police and fire.
So moved.
Seconded.
Ready to vote, Marty. You're on mute.
Well, how about that? Trustee Mead,
Yes.
Trustee Polika,
Yes.
Trustee Piana,
Yes.
Trustee Pache,
Yes.
Trustee Gaucho,
Yes.
and Chair O'Loughlin.
Yes. Thank you.
That's it from our end. I want to give a little bit more time to what Cheryl has here for 3B, just because I think that's a little bit more of a conversation. I did include in the supplemental slides, Mike, you had posed a question at the last meeting about...
Brian,
Yeah.
the employee side needs to accept your liquidity report.
Sorry.
Have a motion?
I move to accept the liquidity report as submitted.
I support.
Okay. Trustees Gaucho,
Yes.
Kiana,
Yes.
and Polika.
Yes.
Thank you.
Brian, you were saying?
Yeah. So, Mike, you'd posed a question at the last meeting about real estate and benchmarking and whatnot. So I put a couple supplemental pieces together at the back end of that. I want to defer a little bit more time to Cheryl and the conversation we're going to have around this 401h account. So if it's all right with you, and connect with you on a one-on-one basis to walk through that, and we can bring that back to the next meeting for a deeper discussion. I just want to make sure that we're answering all the questions that you had around some of the discussion we had at the last meeting.
Okay. All right. So that's not in the packet.
It is in the supplemental. It's in the back end of that supplemental packet.
Okay. Thank you.
Okay, the next item is that the 420 and 401H reports, correct?
Yep.
And this is specific to the employee system, correct?
This is specific to the employee system.
Okay.
So as you know, the employees retirement system has been closed since let me call this up,
1996.
1995. In 1995, we had the highest members in that group. So it's been closed for over 20 years. There are only 45 people left in that group. And based on our actuary report from last year, it was 290% funded. Some quick math, and even with the current 19.5 million that's in there right now, we could still cover the benefit payments, which are about 7 million a year, or 7 million in totality, at least, 2.5 times over. So the fund is still anywhere between 290 to 275% funded. And the money is just sitting there right now. And what would normally happen is until the last retiree is out of the system, then the money reverts back to the general fund. What I would like to do, or what I'm going to do, is start researching and put a policy together, because we are paying almost $2 million a year in retiree health care that comes out of our general fund. So there is a law that allows us to take the money from the general employees retirement system that's overfunded, if it's a qualified system, which ours is, and transfer that to a 401h account, which is a very specific account that can only cover medical benefits. Tom,
That is correct. Yep.
as soon as I misspeak, you guys let me know, right?
No, you're on a roll. You're doing well.
Okay, so if we transfer some funds to this 401h, then we can pay those 45 retirees' healthcare costs out of that pension system fund. But we can't pay it out of the pension system. We have to transfer it from the pension system to this 401h, which then can only pay for specific retirees' healthcare. My calculation, this will relieve about $800 to $1 million a year from general fund expenses, and actually have them come out of the pension system via this 401h. Now, what I'm gonna research is putting a policy together so that this happens, the transfer can only happen once a year. It has to be a qualified system. There's a lot of IRS regulations and hoops and things to go through. So with the help of Brian and Tom, what I want to do is go through the process of setting up the 401h, getting a letter, getting it approved by the IRS, and then once a year make a transfer of all of our healthcare coverage costs for the employees of the employee retirement system, make that transfer from that 401 to the general fund to cover those costs. I think that we could do this for probably, even in light of the economy right now, we could do this for at least 7 or 8 years without any detriment to the entire employee retirement fund. I would definitely want to set up a threshold, like 175, not to go below the 175% funded. So at $7 million, that would put us at about $12 million. That would still leave us approximately $8 million over the life of the plan to pay any healthcare costs for those retirees. It's just a way to allow us to utilize those funds to benefit those retirees instead of leaving it tied up and wait until everybody's gone so we can put those funds back in the general fund. I think it's the best use of taxpayer dollars. I think it's the best use of those investments that we've put aside for the employee retirement system. And I think that's all the important stuff there. Like I said, it's not just like Cheryl gets to transfer money from here or there and spend it any way she wants. There's a lot of really specific guidelines. Just pension funds, there's a lot of things that I need to do, and I would, use Tom's guidance to help walk us through those and make sure that we're in compliance with everything that we need to be in compliance with to satisfy those funds for the retirees. That's kind of it in a nutshell. If you have any questions or if there's anything that gives you chili peppers, let's chat.
Cheryl, when would we know when we would make those annual transfers? If I'm hearing you, you could, once this is approved by the IRS, if it's approved, submit essentially an annual report at the same time that you would transfer. So this would always be memorialized once a year. Is that correct?
Yeah, I usually, so we're self-insured with our healthcare coverage. So I usually kind of do a tidy up task in June or July to tidy up for the fiscal year. So similar to that, where, I see exactly how much we've spent on those particular employees. I use a calculation to determine the spread of all of the medical costs because obviously because of HIPAA, I don't assign them to each individual department. I use a general allocation formula. I do that towards the end of the year. We could also do it during budget time because I look at them in depth as well. So we could pick the time that we're going to do it. We could do it during budget time and then make the transfer in June if it still stands. There's a couple things that we could put in place that would really solidify that the amount is correct and we're not overspending or overcalculating. And as Brian mentioned earlier, the funds, the benefit payments in that fund are not going up. They're only going down. There hasn't been anyone added to it in 20 years. The benefit payments would go, the healthcare payments are for the retiree, their spouse, and their beneficiary. None of that stuff would change. This would just allow us to continue to provide that benefit.
And it seems like this is a behind-the-scenes move where the consumer in this case probably would not even notice anything.
No, the only thing that they're going to notice is a transfer into the general fund into the funds that have those employee retirees to cover those healthcare costs. So there would be a reduction in the amount of expenditures in the funds that have those retirees in them. Because right now the general fund carries just on out of our tax dollars.
Right.
So, but behind the scenes, they're not going to see anything because we're going to carve the money out of the employee retirement system and put it into this 401. And it's just going to be that one little annual chunk that will transfer over. And then that will be used to pay the healthcare costs. So it will be an additional account in our system of accounts. I think we have like 8 now, 6 or 8. including cash. So it would just be an additional one for the employee side.
Can I interject for 1 second?
Absolutely.
Even though I'm not on the ERS board, just off the top of my head, you know, I'm just wondering if maybe we should wait for an actuarial report, just because our liabilities aren't changing, but our assets are changing drastically. And I'm wondering if we should maybe wait, you know, this is just my thought, that maybe wait for the actuarial report to determine like what kind of amounts would go, you know, be transferred to the 401H. I don't know. Tom, do you have any input, any
Yeah,
insight on
Mike,
that?
if I could, yeah, I think at this point that we know the liabilities, we know the assets because Brian is reporting them. You know, any impact of the market is going to be smoothed out anyways over a number of years, because that's how the actuary looks at it. So, you know, I think at this point we can anticipate what the market impact is and move forward, even though we don't have the next actuarial valuation. Because even if you do get the next valuation, it's only going to slightly be modified in terms of funding levels because of the smoothing aspect and the fact that there's no new members in the system. That's really the deciding factor. Since it's a closed plan, it's more controllable.
Yeah. Okay. Thanks. My just concern was about the assets. So.
Yep. No.
Oh,
Yeah,
and Mike, if I may, so the numbers that I used for my report, I took out of the June 30, 19 actuarial report, and the assets were 20.6 million. Brian just said that the assets are down about $1 million, so they're at 19.5 million. And the amount that we need to cover the life of the plan is 7 million. So it's still at least more than 2%, or more than double the amount in the plan to cover. So I feel pretty confident that even if we took another hit like we have for the first quarter, we'd be down to 18 million and are at least 100% funded.
Okay. All right. Thanks.
If I'm understanding the mechanics of this correctly, it's going to take about 6 months for approval. So your number, your actual transfer number won't be till next spring, in theory. Is that correct?
Yeah, that's my plan, is to set it up for next year. We're not gonna, we'll never get the IRS approval right now for this year. So this is theoretically, you know, 12 to 14 months of planning and making sure that all of our I's are dotted and our T's are crossed, that we're doing this absolutely by the letter of the law and making sure that everything is appropriate.
So from a budgeting perspective, we wouldn't budget any impact of this until fiscal 22, next July 1, probably.
Well, I think that we could probably do an adjustment to 21. I know that we're going to have to do an adjustment to 21 anyway. So I kind of aim for having this done by the end of fiscal year 21, because I think 21 makes me really nervous right now. And it would help us to have some of the healthcare costs for the retirees covered in that budget. So that's kind of my plan. But I mean, we've been paying all along. So if it takes, you know, until fiscal 22, then it takes until fiscal 22. It's not, there's not a like drop dead date that it has to be done.
I want to clarify the general fund.
I do have a question for Tom. When I was researching this, I saw something in the 401H code that said it was like a sunset of 2025. Does that sound familiar to you? So
Yes.
can we not before then, and we can't transfer after? What does that date signify?
I think that would be the transfers. You can make transfers, but if in 2025 it's not extended, and these are, you know, these are routinely extended.
Oh, okay.
Sunsets. But in the event that it wasn't going to be extended, at that point, as we've talked about before, there is the ability to accelerate the transfer amounts. And so you could make an adjustment in the future as opposed to doing it annually. you could do a multiple year transfer amount if the regulations were not extended or they were changed at that point. But that's a discussion to have, 2024.
Okay, perfect. Does anybody have any other questions or comments about the process?
Sure, I have a couple questions.
Sure.
Does the employee system, does that have an annual actual report, even though it's closed?
Yes, it does.
Okay.
We do an OPEB for everybody. We do the actual report for that and the police and fire.
Okay, and when you say healthcare, it's for all retirees, correct? Not just that
No,
system?
it's just the retirees in that system. So it would only cover health. It would only cover those 45 retirees. It would cover their healthcare costs.
Okay.
Cover anybody else's.
And you say 7 million is what you need in that system to deal with their regular?
According to the last report, which was issued for the June 30, 2019 ending, the present value of future benefits, sorry, that gets weird, is $7.1 million.
That's off their last actuary report?
Yes.
Okay.
I can email you a copy real quick. I've got one.
No, that's good.
I have a digital copy.
And that number would only go down, it would not increase because it's closed.
Right.
Correct.
Do you know what the average age is in that 45?
I did not see that in the report. I might be able to pull that from some of my data. We're getting ready to pull all the data for the new reports. So when I get that information, I'll send it to you. Because again, the retirees, their spouses or their beneficiaries. So that's a benefit that carries on.
Thank you.
I just grabbed it. The average age is 79.
Thanks, Brian.
And one other comment, and Mike, this kind of goes to, I think, to your earlier question. The other piece that we're doing in this is we have been working with Cheryl modeling this is some of the budgeting stuff and cash flow models that we've built don't use the discount rate. So we say we need $7 million to cover the projected benefit payments. That's under the assumption that the assets are going to grow at that discount rate. There's also an exhibit where the actuary says, no. Okay, here's, the discounted number is $7 million, but the actual cash flow number is 13.5. We have another exhibit that we put together that says, okay, let's even assume worst case scenario, and it's not 5.5% growth every year for the life of the system, it's 0% growth. So that we have that as like another backstop just to make sure that the retirement system stays protected and this doesn't diminish the strength of the position that it's in. So there's another layer of, I'd say, protections put in place that as we look at this every single year, we make sure that we continue to do the right thing.
Okay, thanks.
You know what, Brian, that brings another question, and maybe we can have this conversation offline, but Tom, maybe this is you. With my OPEB funding, if we're going to do this 401 for these employees, can I take them out of my OPEB model?
Why don't we reserve discussion in terms of the details, for a future conversation?
Okay, perfect.
Thank you. I just really want to get on to my next Secure Act presentation.
So
Sounds exciting.
I will move to accept and receive this report from the finance director.
Support.
Okay, trustees Polika,
Yes.
Piana,
Yes.
and Gutcho.
Yes.
Thank you.
Tom, whenever you're ready.
Thank you for that dramatic buildup. At the risk of talking about more internal revenue code sections, I will just summarize in saying there's been a number of different regulations and laws that have come out in the last few weeks. This one is specifically dealing with the IRS and the notice that you provide. The board needs to provide kind of an explanation of taxability of any distributions. It's summarized very nicely in your packet, but from a standpoint of the rule, there needs to be a very, very technical fine tune to the notice that you provide. And my recommendation would be is that you just update your notice to reflect that now distributions don't have to begin at 70.5. They can begin at, they have to begin at 72. So from a practical standpoint, that really has no bearing on your system. From a technical standpoint, I would suggest that you just in the future, use the new updated notice. And other than that, everything else is, business as usual. And we'll continue to keep you up to date as things progress. But at this point, this is more for your information. And then from an administrative standpoint, just to use the updated form. But I would be happy to answer any questions about the IRS, but I wouldn't be surprised if I don't have any questions. And that concludes my legal report. Thank you.
Do we need to make a motion to implement your recommendations here?
You can accept the memo and implement it. Yes, that'd be fine for the minutes.
All right. Is there a motion to accept and implement the memo presented by our council?
I move to accept.
Support.
Trustees Pichet,
Yes.
Piana,
Yes.
Gotcho,
Yes.
Mead,
Yes.
Polika,
Yes.
and Chair Lachlan.
Yes. Does that apply to both systems, Tom?
Yes, it does apply to both systems.
Okay. All right. Information only, executive order. Is that?
I added that just for the edification of the board, but Tom, if you have, I know your office sent a memo yesterday about it, if you'd like to provide a little overview.
No, it's just an update that we can continue to have the ability, and as we always have, to have meetings electronically. And Marty's done a nice job teeing this up, and I think we'll continue to keep you up to date if there's any changes in terms of the regulatory at a state and federal level. But business as usual, and that's all I have on this one.
Thank you.
Anybody have any questions on it? No.
No.
All right. Approval of the minutes from the February 12th, 2020 joint pension board meeting. Is there a motion to accept?
I move to accept.
Support.
Trustees Piana,
Yes.
Polika,
Yes.
Pichet,
Yes.
Gotcho,
Yes.
Mead,
Yes.
and Chair Lachlan.
Yes. And that's for both systems, correct?
Yes, I combined them.
All right. Sounds good. Does anybody want to bring anything else up or any other business? right, hearing no new business, we'll adjourn the meeting. Everybody have a good day.
Thanks, everybody.
Thank you.
Thank you.
Thanks all.
Stay safe.
Good to see
Take
ya.
care.
Thank you.
Bye.
Cheers, everyone.